Welcome back. 10 minutes left of trade in today's session. Joining our closing bell exchange, Jeffrey Sherman, Deputy Chief Investment Officer at DoubleLine, and CNBC's Rick Santelli. Very good afternoon to you both. Jeffrey, if I start with you, clearly great run-up year to date in stocks. What has driven that most of all, and is there still fuel in that particular tank?
Well, the fuel is the questionable part, but I think thus far it's been the what people are referring to as the pivot from the Fed. And essentially, Mr. Powell from about 4 months ago signaling that we had automatic pilot for the quantitative tightening program. We're going to continue to raise rates. Everything was great to the big pivot, not only at the beginning of January, the January Fed meeting, and then going even more dovish when it came to the March meeting, where not only did he signal that the rates will stay and hold the rest of the year, but also the unwinding of the balance sheet will cease to continue by the fourth quarter of this year. So ultimately, it's the Fed put, I think, that's been in play here, which has not just benefited the stock market, but risk assets in general across the U.S. markets.
So we've seen the move, Jeffrey, and we're now within, 1% of a record high on stocks. The 10-year yield in the 250s. I mean, where's the opportunity right now?
Well, it's tough because essentially you are where you were roughly as we went into the fourth quarter before essentially there was a self-inflicted wound by the Fed, just ignoring some of the signs that were coming from the weakness in the global market. And so you have to step back and ask yourself, do you feel better about the economy today and where we are in the cycle than you did roughly 6.5 months ago? And so, as you mentioned, stocks are near their highs. They're actually at a new high if you include the dividends reinvested. But what you have that's different is essentially 10-year yields are roughly 50 to 60 basis points lower than they were as we went to the fourth quarter of last year. And so really the only thing that's changed outside of the volatility is yields in the Treasury market are slightly lower. So as we look across the board, one of the more attractive areas across the fixed income sectors happens to be emerging market debt. And a lot of the troubles and tribulations that get attributed to the emerging market space are the strength of the dollar, which the dollar has been extremely range bound this year and really just can't break this new high levels. It's roughly about 0.5% or 75 basis points off the highs. And so we think that's still an accretive area to be where it has a better spread opportunity, we think, than comparable U.S. corporate credit, both in the investment grade as well as the below investment grade parts of the market.
So, Jeffrey, question on those near record high stocks. Your boss, the other Jeffrey, Gundlach, has said a few times that we're in a bear market, and he had characterized this bounce in 2019 as a reaction to what we saw at the end of 2018, the worst December since the Great Depression. Are you guys still thinking we're in a bear market, and then would you be a seller of this market?
Well, you got to go back to the definition of a bear market, which is somewhat arbitrary, but we tend to agree that the definition is a 20% sell-off from the most recent high. And usually when you go down like that, what you have to do is set a new high to get out of that bear market. So thus far, we still characterize it as a bear market rally. And I gotta pose the question, what has changed over the last 6.5 months since we set that last high? The economic data has slowed. The only really positive attribute we can find is that maybe people got too pessimistic, and you're apt to see some rebound because the data has been slowing so much. But we think that if absent some catalyst, just as Rick had mentioned, you need something to drive this. And we've been waiting for trade for over a year now. And so we like to use it as a headline to say, okay, trade can bail us out of here. But effectively, I think trade is priced in. A lot of good news is priced in. And so the question is, what could actually take us higher? And we're really struggling to find at this point. So, yeah, we think at these levels, we're definitely not an aggregator or adding to positions. We're not a buyer. And probably if you didn't like the feeling you felt during the fourth quarter, you should be a seller at this level.